All right, let's get right into it. Today we're looking at DTE Energy, a company that is, frankly, living a double life. For its customers, it's a story of constant frustration. But for investors on Wall Street, it's a story of massive opportunity. So the big question is, how can both of these realities be true at the same time? Let's break it down. And this, right here, really cuts to the core of the issue. On one side, you've got customers talking about sky-high rates, terrible service, and the problems that come with a monopoly. Then, on the other side, you have investors buzzing about earnings growth, huge deals for AI data centers, and massive capital investments. I mean, these are two completely different conversations about the very same company. So let's start with that first reality. The view from the street. Why are so many people in Michigan so fed up with DTE? It really boils down to one simple question they keep asking. We're paying more and more, but for what? This quote just perfectly sums up the feeling on the ground. It's this really painful combo of feeling like you're paying a premium price for a service that you can't even rely on. I mean, that's just the worst of both worlds, right? And look, this isn't just a feeling people have. The data absolutely backs it up. In 2023, Michigan was ranked number 2, second worst in the entire country for electricity reliability. So when people complain about the power going out all the time, well, the national stats are right there with them. And this really gets to what a lot of customers believe is the root cause. They don't see DTE as a public service. They see it as a for-profit company that has one primary legal obligation: make as much money as possible for its shareholders, even if that comes at the expense of its own captive customers. For so many people, the math just doesn't make sense. They see the company reporting $1.5 billion in profit and then, almost in the next breath, turning around and getting a $242 million rate hike approved. You can see why, from their perspective, that disconnect is just impossible to ignore. Okay, let's hit pause on all that. We're going to flip the script completely now and look at DTE through Wall Street's eyes, because from an investor's point of view, the future for this company couldn't look more promising. The excitement really starts right here with their latest numbers. Their first quarter earnings per share, which is a huge deal for measuring profitability, came in at $1.65, crushing expectations. And revenue? A massive $4.4 billion, which just blew the forecast out of the water. For investors, this is a sign of a company that is absolutely firing on all cylinders. And it's not just a one-off good quarter. The company is so confident that they've actually raised their official guidance, which is their forecast for the future. They're projecting a really strong 6 to 8% growth in operating earnings. That's the kind of forward-looking statement that gets Wall Street very, very excited. So where's all this growth coming from? Well, this slide basically lays out the playbook. They're on the verge of landing massive deals to power AI data centers for giants like Oracle and Google. They're cashing in on renewable energy tax credits. They're in the middle of this huge plan to modernize the grid. And as a result, the big money, we're talking Vanguard, Millennium, is pouring in. So how do we square these two things? The angry customer on one side and the thrilled investor on the other? Well, the absolute connection point between these two realities is understanding where all that money from the rate hikes is actually going. The connection is this number, $36.5 billion. Just let that sink in. That's the price tag on DTE's investment plan for just the next 5 years. It's a mind-boggling amount of money, and it is the single biggest reason for both the high rates customers are paying and the incredible growth investors are expecting. And where is that money going? This chart is so important. Over 90%, the vast majority of that $36.5 billion budget is going toward fixing the grid and building out renewable energy. You know, the very things customers have been complaining about for years. And this brings us right back to the customer's world, a reality shaped by years of power outages and frustration. They're looking at the past, they're looking at the present, and they're asking a totally fair question. When does accountability finally kick in? But then, on the complete flip side, you hear this from DTE's CEO. He's pointing to new data and saying, hey, our investments are already paying off, claiming a gigantic 70% improvement in how long people are without power. It's wild. Both sides are looking at the same problem and seeing completely different things. To really get how this is all possible, you have to understand the business model itself. It's a little strange. See, regulated utilities are given a monopoly, but in exchange, their profits are regulated. Here's the key part.
They don't make money by selling more electricity. They make their money by getting a guaranteed rate of return on huge, state-approved construction projects. So for DTE to grow its profits, it has to spend billions on the grid, and that spending gets paid for by, you guessed it, customer rates.
This all leads to the critical question, right? What happens next? What happens when the customer's reality and the investor's expectations seem to be on a collision course? Where does this all end up? This is the multi-billion-dollar question for DTE. Is it even possible to pull off a plan that keeps Wall Street happy without completely alienating Main Street? Or are the demands of these two groups just, at their core, fundamentally opposed to each other?
So what should we be watching for? It comes down to three key things. First, the regulators. Are they going to keep approving the rate hikes DTE needs to fund this massive plan? Second, those big tech data center deals. Do they actually get finalized and bring in all that new revenue? And third, and this might be the most important one, the reliability metrics. Will customers in Michigan actually feel that 70% improvement the company is talking about?
And that leaves us with one final thought to chew on. Are these high rates and all this spending just the necessary, painful cost of building a modern, reliable AI-powered grid for the 21st century? Or is it just the steep price Michigan is paying for a system that allows a private monopoly to profit from something we all need? The answer to that really depends on which reality you're living in.